Hi, I'm Tom Elliott, Director of Beulah Capital, and welcome to our market update for December 2014. Well, it's been a very interesting time on financial markets recently. The Australian dollar has been absolutely pummeled on the foreign exchange markets over the last few weeks. Also, shares have been fairly volatile, bouncing between the 51.50 up to about the 54.50 level on the ASX 200 index. And perhaps most importantly for Australian investors, commodity prices such as iron ore and oil have fallen precipitously in the past few months. With me here today is Beulah Capital's Chief Investment Officer, Peter Mavromatis, to say what this means for those of you watching. Peter, good to be with you.
Great to be with you, Tom.
First up, Peter, let's have a look at the global economy. How's it been tracking lately?
Well, it's been a bit of a mixed message over the last few months, Tom. The US economy continues to go from strength to strength as retail sales, capex spending and indeed industrial production goes to new highs. However, if we look further abroad, Japan has come under a great deal of pressure due to an unnecessary, in my view, sales tax hike. The European economy has been hurt by sluggishness out of Germany, Italy and Spain, and meanwhile China has also slowed to about 7.3% growth over the last 12 months, which is a little bit below its 7.5% target for 2014.
Probably one of the reasons, of course, that the iron ore price has been absolutely smashed in the last 6 months. Okay, so what is this mixed message from the global markets, global economies? What does it mean for the Australian economy and perhaps more importantly, the Australian share market?
Well, it's certainly not a great flow of news for the domestic economy. A slowdown in China has obviously hurt iron ore prices, and we've also seen a very strong and sharp decline in oil prices in recent weeks. And that's as a result of OPEC deciding not to cut production even as supply moves to near record levels. In terms of the market, we think that stocks that have international earnings such as Amcor, CSL and Brambles will continue to perform well over the next 6 to 12 months, whereas other domestically focused companies will probably battle.
And again, that weak Australian dollar, which many people think could go weaker, is going to help companies with strong US dollar earnings. Okay, now Australian interest rates, the pundits are saying that these could actually be cut early in 2015 because of weakness in the domestic economy. Meanwhile, however, the US Federal Reserve is talking about normal interest rates next year, which means a positive rate of interest, which America hasn't had for a while. How has this affected our fixed interest strategy?
Well, that's a great point, Tom. We've been repositioning our fixed interest strategy in anticipation of rising US rates, which we expect will take place in 2015. At the same time, the weakness in the domestic economy, just last week, we had a very modest rate of growth for the September quarter, which came out. We could in fact see one and as many as two interest rate cuts domestically. So Tom, what we've done is we've reduced our hybrid exposures further in recent times. At the moment we've put that into cash, however we are looking to add another manager into the portfolio. We are very keen, of course, to secure the capital within the defensive assets of the portfolio.
All right, we'll leave it there. Peter, good to talk with you, and to everybody watching and listening, have a great Christmas, also a good year, and we'll talk to you again in early 2015.